Hey folks, Dan Frio here. The rate update today is December 23rd, 2021. There's a lot to unpack today. So we got the PCE and the unemployment claims and a whole bunch of other things. So don't go away. We're going to talk about that next and how that's affecting the markets. All right, so we got a lot to unpack today. Let me get my big head out of the way and go through the economic calendar for today. We're going to focus right over here on Thursday. Durable goods orders, ex transport, initial jobless claims, continued jobless claims, the core PCE, personal spending. There's a whole slew of stuff. Look, there's a laundry list. Well, I got some great news. We're going to listen to CNBC cover all this, and then I'm going to come back and unpack it and put it in a nice little bow to make sense to you guys before the holiday. So watch this, and then I'll be back to explain it all next.
It's a litany of data points. I'm going to catch my breath here. Here we go on initial jobless claims, exactly as expected, 205,000. And until I see revision, that's down 1,000 from last week's 206,000. It's not a post-COVID low, 188,000 from a few weeks ago and that was the lowest level since 1969. Continuing claims, though, has made a new post-COVID low, and that is 1,859,000. I take that back. Last week, 1,845,000. This week, 1,859,000. But here's why I said that, because last week just got ramped up to 1,867,000 on the revision, so this week does stand as the post-COVID low. Now let's get into some real important data. On the personal income side for November, up 0.4, exactly as expected. Some may say, of course, that this number needs to go up a bit, and I think it's going to be. On the spending side, up 0.6 as expected, and last month it was more than double that, and it was 1.3, now at 1.4. We all know what's going on here, that many spent early for the holidays, a little worried about supply shortages. On the inflation side, some of the Fed's favorite inflation numbers here, personal consumption expenditure, PCE deflator, month over month, up 0.6. Last month was changed to up 0.7. These are the hottest numbers going all the way back to 2008. And if we look at a year over year on that number, well, it is up. It is up 5.7. Yes, 5.7. And 5.7 follows an upwardly revised 5.1. That takes us to 1982 since we've seen a number that large. Now let's look at core deflators. Personal consumption expenditure, core deflators, month over month. Means we strip out food and energy. And that number is up 0.5%, up 0.5%. And that follows another up 0.5%. These numbers go back to about 2000, let's see, about 2001. And finally, with the final inflation numbers year over year up 4.7. That really is hot. Once again, that takes us back into the 80s. Let's look at durable good orders. Up 2.5. This might be one of the biggest surprises thus far outside of inflation. We're expecting a number under 2%. This is preliminary November. It could change, but it's a powerful number. And last month, the minus 0.4 gets revised to a final read of up 0.1. We take the minus sign away. Take out transportation, the number falls off rather dramatically, only up 0.8. And if you strip out transportation and look at the orders and shipment side, we have capital goods orders, non-defense ex-aircraft. That's a proxy for business capital investment spending. That's down 0.1. That is not good. 0.1 is not good. Last month, though, was really quite spectacular. Moved from up 0.7 to up 0.9. Year over year numbers are still powerful, but everything starts with a rate of change. Not a good number. We'll see if it's revised away on the final. And finally, if we switch from orders to shipments, it's up half what we expected, up 0.3. And if you think about it, it makes a lot of sense, considering the world and the supply issues we are contending with. Now, after all of that, we're hovering at 1.46 in tens. Actually, European yields seem to be snugging up a little more aggressively than U.S. yields. Bund yields are up for the fourth straight session, meaning they're getting smaller, less negative, and they're at a 1-month high. Joe, I'm out of breath. I hope we covered that adequately. Back to you.
Yeah, that's why the 10-year is not doing much, because it has no idea what to do after all that, Rick. It'd have to be a supercomputer. Thank you. Steve Leisman joins us now. We're speaking of supercomputers. Rick did a great job, Steve. You've had some more time than Rick had on the fly.
Yeah.
What's in there that
the
really,
longer he goes.
Yeah. What caught your attention?
The longer he goes, the more time I get. Nobody does it better than Rick does especially with a big data download like that. He uses
revisions, everything. Yeah, agreed.
It's amazing. It's amazing. But let me just very quickly. What I was focused on when Rick was talking were the real numbers, and the real numbers are not that impressive when it comes to spending and when it comes to income. Let me just go find it real quick. And what you find is that income, when you take out inflation, is down 0.2. That's not as bad as the 0.3 the prior month, but it's still negative because you get your income, you take away the inflation, you end up down 0.2. Also, the spending, personal consumption expenditures, you take out inflation, you end up at 0. So, again, that's inflation taking a bite out of all of this. I don't mind the durable numbers. As Rick said, we had a very strong several prior months here, and I'm seeing a little bit of movement on the auto parts side. We knew Boeing had a big month. Really watching what's happening with auto manufacturing, auto production, to try to see if we can get ahead of what's happening. If you're going to have a decline or a peaking of inflation, you got to get the auto sector back in line, and that's a big part of this right now. What's happening? The conversation that I'm reading among economists is not inflation high this month or next month. It's the talk about the peak, Joe. And what we're hearing is what people are saying is probably February. Things are going to get worse until February, and we're looking for some kind of peak in March, and whether or not things start to trail off back then as the production system gets back into place. And we'll see if we can start to make some, leveling off here. Rick is right. We keep taking out old records from 30 years ago, 40 years ago, and we're looking for a peak hopefully early next year.
Well, there's not much more I can say there. So let's break down what all this information is doing for the markets today. So first thing we want to look at is we already looked at the economic calendar. So now let's get into where did rates open for today, and we are right here. So I'm going to break this down for you real quick, and then we're going to go over and see what the markets or how the markets are reacting. The 30-year fixed rate opened up today at 3.25. It is up 3 basis points from 3.22 yesterday. So let's recap going across here so you get it. The 30-year fixed rate, 30YR FRM, that's what that means right there. Today we opened at 3.25. Yesterday we were at 3.22. That means it went up 0.03. So our lingo is the 30-year fixed, 3.25. Yesterday 3.22, up 3 basis points. Hope that makes sense. We got the 15-year at 2.59, the FHA/VA at 2.85, the jumbo at 3.12, and the big volatile 5-year ARM coming in at 3.3, up 10 basis points. Okay, so that's what's going on with rates, how we opened today. So now let's get into what the MBSs are doing in reaction to all this news. Why do we watch this? Well, at the end of the video, you might have paid attention to one of the CNBC commentators saying, well, the bond market or the 10-year is flat. Okay, they're watching right over here, the 10-year Treasury, because that's a reflection of what most bonds are doing. There's a disconnect many times between the 10-year Treasuries and the mortgage-backed securities. With the mortgage, well, let's explain this. The 10-year Treasury is obviously the 10-year U.S. Treasury bond. Okay, so we scroll over to here and we see UMBS. This is a mortgage-backed security bond that trades on Wall Street, very similar to the Treasuries. And there's a little bit of an uncorrelation right now because of the yield differential. I won't go into all that. I just want to explain to you what's going on with mortgage rates. So when this number right here, this is the number of representing the price of the bond. This is where the yield is. So when you see the price in this situation going down, prices down, rates up. Okay, that's how it works. the less you pay for a bond, and you just saw it click to 17, the less you pay for a bond, it drives up the yield. So we love when the prices are going up, okay, because you're paying more for the bond, reducing the yield on our end of it. You got to remember, the yield in most bonds is what you're going to recapture as an investment. The yield on the mortgage-backed security bond is how much you're going to pay out on your mortgage rate. Okay, so there's a differential there. So let's get on to more of this. So that's where we see it right now. I'm not concerned about this number because there's probably nobody working in the pits right now on Wall Street to counter any trades that are taking place. So let me put that in a little bit of context. If there's a minimum amount of people working, and let's say I want to sell my stock, that price is going to drop down until there's somebody working that wants to buy that bond from me. So if there's very limited amount of people working, then that bond can drop and drop and drop in price till the point of somebody's like, okay, I'll buy the thing. So I'm not really concerned the day, 1 or 2 days before the holiday and the day after, when there's a limited workforce on the floor of Wall Street. It really doesn't concern me because usually it counterbacks and corrects itself the following week. So that being said, let's get on to some more data over here. What is the intraday chart doing? Well, we're going to click this, and there is red all over the board. So you can see, again, we normally don't see this big of a red candlestick. Basically what that's telling me is that price continued to drop all the way down to where somebody could buy it. So if I'm trading today, I'm really not doing anything. If I'm working on your mortgage, I'm not doing anything because I'm not going to let this reflect if I'm going to lock you in or not. You can see the sporadic, the huge differentials or the moves in the red candlesticks there. Okay, so that is it for right now on that. So if you like my videos, all I ask you to do is just do me a favor. Take 1 minute and just go down below and click the like button. Also subscribe. It helps me and helps the YouTube algorithms get out to more and more people. And but other than that, if you'd like to reach out to me, if you're looking to buy, build, refinance, just have questions. You're in a forbearance, you want to pull out cash, you're in an FHA or VA loan, what's the best way to refinance? Just call us. The best way to do that is right up here to the top right. It's 844, I know it's a little small, 844-775-5626. Or what a lot of people are doing, we do a lot of business on the West Coast. So we're in Chicago, so we're a couple hours behind you. So by the time you get home at 6 or 7 o'clock, it's way late here. Don't miss out, okay? What you do is just click over to the top right here. Over here, right up the bar, and you're just gonna schedule a meeting. Click it, it'll open up our calendar, let you guys know what days and times we have available for you, and then we'll do that either by Zoom or by phone call to make sure all your questions are answered. That's it for today, guys. I'll be posting a video over the weekend I'm working on right now, crypto and real estate. I think you'll find it very informative. So God bless, guys. Take care. Have a fantastic Christmas. Merry Christmas to you. Yeah, I said Merry Christmas. So if you're offended, my apologies, but I'm really not apologizing because I consider it a Merry Christmas. So God bless. I'll see you guys in a couple days. Bye-bye.